Apologies. Speakers can be late, the chairman shouldn't be.
Yeah. I agree.
Well, all right. So our first speaker is Mike West from Duke University, who will speak on sparsity modeling for large-scale dynamic models for portfolio analysis.
Well, some of those topics modeled together. It's a very different flavor of topic than most of the talks so far. And is very close to an extreme in terms of being very applied. I'm not sure these days whether that's left or right, but it's very extreme. And it's just a soup-style collection of topics from some work that we found interesting in the last couple of years. Carlos was a student. He's now gone on to greater things. Craig is an undergraduate. The best thing in the world when you're really stuck for ideas is to talk to a 19-year-old. And Pepe Quintana, who's not a co-author on any of the papers that are referenced here, is a long-term collaborator who runs lots of these models in the background of his various operations and helps us think about interesting research questions. Okay, so I'm interested in, this is about putting structure through graphical models into multivariate time series because it helps you make money. That was the general question, just a few experiments. I got very interested in mutual funds recently. As you get older, you get more interested in how your pension investments are doing. And I'm going to talk a little bit about some of the sort of quasi practical questions associated with that. There'll be examples on stocks and financial time series of various kinds. One of the interesting components for this meeting, it's not, well, there's lots of data, but really it's the parameters that are huge. And of course, models structure that, so the effective dimension is low. And there are some questions, open questions that we have no idea about in graphical models in particular, about how structure changes, sparsity structure changes when you look at different reductions in terms of modularization that have a role and have a relevant, very practical relevance in some of our work. So from the theoretical point of view, there's certainly some opportunity for those of you that can to get involved here, and I'd like to hear of any good ideas. Okay, so we're going to talk about time series. We're going to talk, basically it's a tutorial. There'll be a few slides on graphical models. I know most of you know a lot about them, but I know that some of you don't. So there's a little bit of a tutorial there on graphical models for structuring a covariance matrix in a multivariate normal distribution, sometimes called covariance selection models, for reasons that have escaped me for years. And basically, the overarching context is marrying these into multivariate time series models of various kinds. And I'll give you a bit of a tutorial on that, just a very basic bog standard model class, which is a building block for other models, okay? But sufficient in the examples to illustrate what we're about here. We're about thinking about a vector of assets and moving through time, learning about a time series model that underlies those assets or that we're using to represent those assets. For one step ahead, forecasting myopic portfolio decisions. We're going to move money around a collection of assets time after time after time and ask a question about how we might best do that. And then investigate how various model assumptions, in particular graphical model structuring, has an impact. So we're interested in stability of estimation in high-dimensional time-varying parameters. We're interested in parsimonious and econometrically justifiable structure that is a parameter reduction. And we're interested, somebody in the last talk said something about if you can predict, you can make money. Well, if you can predict well, you can make money, but you can also lose a lot of money, even when you predict well. And so we'll get back to that too. Okay? Sorry? Oh, it was one that said that, yeah. Okay, so here's some data. This will be one of the examples. So think about it like this. There are a number of ways to think about dimension. I'm actually not sure whether this workshop on high dimensional, does the high dimension apply to the data or to the analysis in high dimensional data analysis? We've got both here really. We've got some number of observations, 1,500 observations on 350 assets, S&P stocks. So the data is reasonably high, but the models are volatility models. Everything's changing, okay? So think about it, a cross-section in time. We've got a covariance matrix and a big model that goes along with it that's, 350 by 350, 50,000 parameters in that covariance matrix, okay? So a time series model reduces parameter by constraints across time, and now we're thinking about reducing parameter by constraints cross-sectionally with a graphical model. Okay, otherwise, it's hopeless. So here's the sort of decision problem context. You've got your money invested in a collection of assets, and let's just suppose, in a minute I'll be specific about models, and there'll be some Greek which represents uncertain things, parameters. When it's Roman, like f and q, these are numbers that we know. Okay, so f is a vector. F is a vector. It's a talk about risk management, so you've got to be here. Yeah? F is a vector and q is a matrix. Okay, so q is 350 by 350. And we're looking ahead one step. The F is the forecast of the return next step, and Q is the variance matrix. Okay? It's volatile. Okay? We're in a volatility modeling context. The variances in the model jump around. Okay? So our estimates of them jump around. Okay? We want to structure things. Again, I'm thinking cross-sectionally. Time series does it that way. Graphical models does it that way. Okay? And there are other ways to do it, I should say. Some of you may be familiar with factor models for variance matrices. We've used a lot of those, and one way to think about what we're doing here is doing the best with models like that to model changes that go into predictions in F, and then everything else is what we're talking about today. Okay, everything else that's left. So here's the standard 1950s Markovitzian portfolio theory. All right, and this is where you begin to get an insight into why sparsity might matter. Each step, you're going to choose a vector A of numbers, and you're going to allocate your fortune according to those numbers, or somebody else's fortune. Okay, you're going to choose some portfolio weights A. And one way to think about portfolios is to say, well, I want to look at portfolios that give me this much money, that make 1% a month, say. So that's your number M. And if you look at those portfolios and say, well, let me minimize the variance across that class of portfolios, there's a unique solution, and that's what Markowitz told us years ago. The optimal A vector is basically precision matrix weighted average of the forecast. So K is a precision matrix, the inverse of the variance matrix. I think Peter said yesterday that the precision matrix is somehow the fundamental parameter in a Gaussian distribution. And all of this is driven by the precision matrix. And then there's some scalar, got to get the right button here, some scalar S that comes in here as well. And what that is the variance of the optimal portfolio. Okay, so as your target for return goes up, the risk goes up because S goes up. It gets harder to make money as you desire to make more money, okay, however well you may forecast. But the point here is simply that the precision matrix drives everything. It drives the decision. Okay? So if this is a big precision matrix and it's full of lots of uncertain entries because the data can't tell you much about them, or because, well, the bigger it is, the more uncertain they're going to be, then that's going to feed through into the portfolio decision. You're going to have uncertainty about your risks driven by uncertainty about the portfolio weights. Okay? This can be modified in various ways to make it more realistic in terms of the portfolios. This is just a very simple canonical example, really. And it's important, and the reason I said somebody else's money, that this is really institutional investors. This is hedge funds. This is not, well, it's not me. It might be you, but generally it's not you and me. Okay? Because these weights can be anything. They can be arbitrarily large, positive or negative. So you have to have the opportunity to go as short, to borrow as much money, to hedge as much as this theory says, to use this theory. Okay? Other portfolios, and I'll just show you some examples later on, you and me portfolios, or certainly me, I won't be presumptuous, are constrained. Okay? I mean, people that work in universities that invest through university funds, or in the UK through, I can't remember how you do it these days in the UK. You don't have any money, so it doesn't matter here. Are required to invest in portfolios of mutual funds, okay? And we have finite fortunes, the change, A, cap A, and we're required to put non-negative amounts of money into various funds, okay? So this all changes. And it changes in very important ways, and we'll see examples later on. The basic issue, the basic idea of the talk is unchanged. Okay, some good things to bear in mind as we look later at examples. We'll be about half an hour on the models, and then we'll talk about the examples. Some good things. It's good to make money, so have high targets for your portfolio. This is something you choose. It's good to have portfolios that you're sure of, that are going to make money. An investment bank is not going to sell investment management advice on risky portfolios. And this relates to the weights, and there are two dimensions of uncertainty really. One is how much you know about the weights, A, okay, so they're dependent on covariance matrices through precision matrices. Here I've plugged in an estimate K. But if you think about a model, the underlying variance matrix is not known, okay? I'm a Bayesian, there's a posterior distribution about it, which gives you a posterior distribution for the weights. And in the main, if that's spread out, so you've got a lot of uncertainty about the weights, then as you move through time, you're going to have variability in the weights. They're going to jump around a lot, okay? So there's just the statistical issue of how much do you know, and it's good to know. And then there's the practical issue of churning portfolios that are moving money about wildly. And when you get into more realistic portfolios where you have to pay for all that, then that's bad, okay? So stable weights, precise weights are two of the good things. Making money is good and low risk is good, okay? So we'll keep those in mind.
So what kind of things are these correlations between precision matrices?
What kinds of things? So stock market, the 350 is stocks, daily returns on stocks. The first example will be in a different dimension. It'll be a very low dimensional example where there are exchange rates on currencies. And then the third example will be mutual funds, okay? So lots of very high correlations, okay?
What about sparse weights? I mean, having portfolios which have all allocating only to a few of the assets.
Very good question. That's slide 39 or something. Okay? To that question, or getting to that question, let's look a bit more at the structure of this particular example portfolio. This is what it looks like. So we look at the optimal vector and go through it one at a time. We take I equals 1, the first currency or the first mutual fund. The amount of money you put into that has this form. There's some constant. And this is being done repeatedly, remember, at each time point. This is what you're predicting in terms of the return on that asset. This is what you're predicting on all of the other assets. These are the numbers basically of the off-diagonal of K. Okay, the partial regression coefficients if it was a Gaussian distribution. So the numerator is a residual. If you can really predict the predicted returns on that asset with a basket of the others, then it gets a low weight. If it's a very variable return in the sense of not being well predicted, that's the denominator. The residual variance is high, then you're going to back out of that asset, okay? The point here is that, again, precision numbers are coming in here, so if you begin to sparsely structure this big matrix, well, what does that mean? In the Gaussian case, that means that this precision matrix has zeros in various places off diagonal. Okay, that's sort of the graphical model idea in a Gaussian case. So if you have a picture like this, this is the K matrix. Black indicates some number non-zero, white indicates 0. Then a lot of the off diagonals, the Kij's are 0, okay, and they fall out of this equation here. Okay, so you can see how sparsity, if you like structuring in the graphical model context, is introducing information that is reducing variability very naturally, deterministically, if you know the graph. So that's basically what we're interested in. What is the effect? And it's just a few examples. What is the effect of that kind of structuring on portfolio decisions? Okay, and the examples come in the context of dynamic models. And I'm going to give you just a few slides on graphical models and a few slides on dynamic models to prepare for the examples. This is the main paper here by Carlos Carvalho and myself, was in Bayesian analysis last year, and also as a synopsis in the proceedings of the Valencia conference, Bayesian Statistics 8. Some supporting and relevant material on graphical models in biometrica last year. I'll give you the reference at the end. And I'll mention the fourth reference again in a second. Okay, so graphical models, I'm not going to dwell on this since most of you know about it. I'm going to use just this example, 11 dimensions. So these are daily returns on currencies relative to the US dollar, and this is pre-Euro, pre-2000, okay? So in those days, it was much more interesting and much easier to not lose money on European currency investments. So here's mainland Europe clique. The mark, the French franc, the peseta, the guilder, the Belgian franc. Okay, nice tight European clique, all related together in a graph. This is a graph, and we've got models on this graph. Here's the British pound that's sort of related to Europe and is in fact part of the EU and was in those days too, but it's still sort of different. It's not completely connected in. Okay? Brits go their own way some of the time. Here's Australia and New Zealand, Japan. Okay, so it's a graph. It's a graph that bears some, it's faithful to financial econometrics, to trading relationships between countries and blocks and so forth, and it just came out of the air. We're just going to look at this graph. This is G. It's an 11-dimensional example. There's lots of data. Before I get into the time series, let's just forget about time series and just, this is just a tutorial to remind us what graphs are and distributions on graphs. If you have a precision matrix in a multivariate normal distribution, zero mean, faithful to that graph, that means that where there are missing edges, the off-diagonal elements of the precision are zero. Okay? So in the linear regression of any one currency return on all of the others, only those with edges incident at the current currency matter in predicting that particular return. The complete conditional distributions don't depend on all of the others. Okay? So that's the structure we're interested in. Okay? In doing calculations with graphs, this is a very simple graph. It's an 11-dimensional distribution, normal distribution, but it's a vehicle for illustrating it. In doing calculations, we break graphs down into little graphs. Okay? We exploit graph theory to do hard calculations on more complicated and higher dimensional graphs. So for example, with this graph, one way to break it down, and the way we do in our example, is into what's called the junction tree of the graph, which is a tree of subgraphs. So the nodes are graphs themselves. Okay? And so for example, the European Union clique comes out as a 5-node subgraph that itself forms one of the graphs of the junction tree. That's separated out from the other nodes through little subgraphs that are inside it, 2 different subgraphs in this case, the French franc and the Deutschmark subgraph, separated from this node, which is the British pound plus those 2 original currencies. Okay? So the breakdown is into subgraphs, which are the components or the prime components. In this case, they all happen to be complete subgraphs. And as you move through the tree, starting here, say, and moving through the tree, the nodes that you've separated out so far as you go through the tree are separated out from the rest of the nodes that you haven't yet visited by a separating subgraph. There are components and there are separators, okay? And these are all complete subgraphs in this example. And everything we're doing, they're all complete. These are so-called decomposable graphs. It's a visual aid, and it's a way to look at the structure that the graph implies and to introspect, does it mean anything? But it's also a way into doing effective computations as we increase dimensions. With a multivariate distribution, with a structured covariance matrix, the inverse has zeros where the edges are missing. On this graph, the multivariate normal distribution breaks down as a product of ratios. You visit each of the component, there's a multivariate normal. So for example, up here, there's a 5-dimensional normal. Here, there's a 3-dimensional normal. You take the product of those normal densities, well, you're double counting the little subgraph that separates them. So you divide through by, in this case, the bivariate normal distribution that's been double counted. So the joint normal density breaks down into little normal densities in a product ratio form that helps the computations along. They have to be consistent in the parameters. Okay, that 5-dimensional intersects that 3-dimensional in a 2-dimensional bivariate distribution. Okay, so the parameters have to be consistent. And the overall variance matrix is a function of some reduced set of parameters underlying those individual lower dimensional norms. Okay, so how do we do inference? Well, one way we do inference is to look at that product form of the joint density for an x and recognize that that will lead to a similar form in sigma as a likelihood function when we see some data. Okay? So if we want to use prior distributions that match that, then we're looking for similar forms in prior distributions over this sigma matrix that is highly constrained by the structure on this graph. And if you need to know more about this, a couple of the key originators of this are sitting in the back somewhere, so we'll leave that till the end. In particular, this paper by Phil David and Stefan Lauritsen a few years ago. The graph is broken down into lots of little normal distributions. They're all fully connected little normal distributions in the sense that in each of those components, everybody's a neighbor of everybody else. So standard normal Wishart theory applies. So one can imagine visiting each of those normal distributions and using an inverse Wishart prior for the little covariance matrix, and then worrying about how they fit together over the graph. Okay? And that's called the hyperinverse Wishart distribution, or the family of hyperinverse Wishart distributions. The conjugate prior for a covariance matrix constrained by a graph is a prior of precisely the same product of ratio of product form as you move through the junction tree. And it has a number of properties. On our decomposable graphs, each of the little normals, the prior is an inverse Wishart for the variance matrix. The overall distribution is a hyperinverse Wishart. You can do some calculations. You can find some moments of these distributions that are relevant for our portfolio problem. You can simulate these distributions, which are also relevant for our portfolio problem. And most importantly, if we now recognize that we don't know what the graph really is in most problems, that the graph that I gave you here is just a candidate graph, there are many other possible graphs. There's graphical model uncertainty. The graph is a parameter. We want to learn at least parts of that. And that's really the hard problem here, and represents an unsolved problem in many ways, computationally, certainly. But in principle, if you can line up lots of graphs, do these calculations with hyperinverse Wisharts on each of these graphs, you want to then think about, well, what does the data say that might discriminate different graphs? What is the likelihood function over graphs? What is the posterior distribution that implies? And most importantly, the hyperinverse Wishart conjugate prior in this graphical model leads to an efficient calculation of the marginal likelihood. We're in Cambridge, we can call it the evidence, the marginal density of the data on that graph, which gives us the likelihood function over graphs. And that has the same form in terms of a ratio of products. Okay. Let's now look at the time series. So that's just the essence of the hyperinverse Wishart structure for structured covariance matrices on graphs. I'm going to give you a class of time series models now where there's a variance matrix, okay? And it's going to be a time-dependent variance matrix, okay? So we're going to now think about our sigma, as I've just described, and think about that sort of graphical stuff. And now move over to the time series case, where there are lots of sigmas moving in time, highly related through time by time series model. And the one class of models that we can actually do analytic computations and have things manageable as we get into bigger dimensions is the one we know about, a building block of many other models. I'm not going to tell you much or talk at all, actually, in the examples about the econometrics and thinking about predictors, but let me just talk about the structure of this model. Sometimes we've referred to it as exchangeable time series. The general class of models applies to a matrix time series, where you would have a matrix of observations at each time point. Okay? So over a number of countries, a collection of macroeconomic indicators. Okay? For today, it's just a vector, and so I'm taking my column vector y and making it a row, just transposing it. And I've got what might be a long vector of independent variables. You just know them. We're not going to talk any more about those. And a matrix of parameters, theta, in which each column refers to one asset. Okay, so if we've got 11 time series of exchange rates, we've got 11 columns. All right? Each currency has its own time-varying parameter vector in the column of theta. And then there's a disturbance, a stochastic component. I'll call it just the unexplained component. It's not error. It's not measurement error. It's not experimental noise. Okay, these numbers y are there's really no error. These are the exchange rates, right? These are the returns on your stocks. All right, these are known. Okay, this is the stuff you can't predict. That's all it is. It's model misspecification. It's how far your model is from reality. And they move through time as well. The model says they're conditionally independent, Gaussian terms, and there's some scale factor we can ignore. And there's a covariance matrix. So this is an 11 by 11 covariance matrix across currencies that represents co-movements of various kinds that you're not predicting or you're failing to predict in the structural part of the model. And that's where we're going to apply the graphical model to. All right? It's a state space model or a dynamic linear model. A state space model in the sense that there's a state parameter, it's a matrix, which is modeled as a time-varying parameter too. Okay? Reflecting variability in time in regression relationships and other things that you might want in there. Some of this may be latent variable components. And the common component models model that as a matrix variate AR1, if you like, which also is influenced. This is a matrix normal distribution. I'll tell you what it is. There's some variance matrix W, which we'll ignore. It's also influenced by the cross-sectional covariance structure in the first equation. Okay? So changes in structure of the time series, as represented by the theta, and changes in the bit that we sacrifice to unexplainable, the new t, are influenced by sigma at each time in the same way. Okay, so what this matrix normal notation means in terms of the random term here is that if you take two columns, so you take the Deutschmark and you take the yen, okay, then the correlation from sigma Deutschmark yen is a component of the covariation between those two columns, multiplying this W matrix. Okay? It's one class of models, widely used class of models in econometrics and finance in particular, and now we're going to try and add graphical models to it. Okay? Before we do that, we've got to say a few words about time variation. We've got these, go back to the first example, the S&P, we've got 350 stocks, all right, over 500 days, and there's a sigma at each day. Okay? So there's 50,000 parameters in sigma at each time t. They're not all free parameters, so they're linked from time t to time t plus 1. Okay? And what we're using in the examples here is variance matrix discounting. Let me just give you the flavor of this. So this is the volatility. This is the stuff that is unexplainable. It's variation over time in the stochastic components of the returns on your investments and the structure as well. And basically, it's like, think about a random walk on matrices, on positive definite matrices. Okay? This thing is moving through time, and the way it's constructed is to take the variance matrix, take its precision, its inverse, take it apart with a Koleski, and put inside it a matrix beta random variable. Okay? So we're used to thinking about random walks as adding a zero mean. Okay? Well, this is a very different construction. It's a matrix beta noise contribution to sigma at each time t that gives us a class of evolution models for the variance matrix. This is well documented. It was the first multivariate stochastic volatility model published by Pepe Quintana 21 years ago. Lots of nice theory was then developed, and there's a much richer class of models that has arisen since. We don't yet know if what I'm going to describe in a minute in terms of putting graphical model structure on top of sigma, we don't know how much of that can be done in some of the more elaborate models that have been produced in the last 20 years. The examples are just in this initial model. Okay? The important point about this model is that in that dynamic matrix variate context, this particular construction of an evolution over time, a volatility model for the variance matrix, maintains the ability to do calculations. It maintains mathematical tractability as we go through time. What does that mean? Well, now I'm going to tell you a little bit about what F and Q are that we started out with. Okay? So now we're moving through time. Actually, we're moving through time this way for you. Right? We're moving through time one step at a time. This model is describing how the time series is evolving. We're learning about everything that we don't know in that model as we go through time. Okay? At time point t minus 1, we're forecasting ahead one time point. Forecast vector F and a variance matrix associated with that Q, all derived from this model. These are numbers we know at that time t minus 1. They feed the portfolio. Okay? That's what the decisions are based on. They're numbers that are then going to change at the next time point. So let's step back one time point. They come from posterior distributions that, as we move through time, are revised by the data. Okay? So generically, sitting at any time point t, based on the data we've seen so far, we have a joint posterior distribution for this matrix of parameters in the structure of the model, the theta, and the volatility matrix, sigma. Okay? And in this simple model context, this is a conjugate normal, a matrix variate normal, inverse Wishart distribution. That, when we change the time index back to t minus 1, tells us how to calculate the one step ahead forecast information to forecast and feed the portfolio decision. Then we see y at time t. All right? We realize our return. We may have lost a lot of money. We may have made some. Okay? We also feed that y into the Bayes' theorem calculation that changes what we know at time t minus 1 to what we know at time t. Okay? So it's updates of sufficient statistics in this particular model that are analytic. And part of that is the particular construction of the evolution model, the matrix beta evolution model for the variance matrix. Okay? As an aside, in more elaborate models, this is a building block. In more elaborate models with latent factors for components of volatility and hierarchical components and all kinds of other fun stuff, can rely on this kind of structure. And it's important to recognize that because as soon as we get into more elaborate models, we're into big MCMCs. And the more calculations we can do analytically, the better. Examples today don't do that. They just use this particular model. OK, so here's the marriage then. And I'm not going to say anything because there's nothing to say. The matrix variate DLM with a time-varying volatility matrix is unconstrained. As we move through time, we're updating an inverse Wishart distribution for inference on the sigma matrix. Okay? Now we're going to try and put that on top of a graph. Okay? Now the precision matrix has zeros off diagonal. Okay? And we can appeal to the hyperinverse Wishart theory that tells us how to think about conjugate priors in such circumstances. The difference now is that we're in a time-dependent context. We're in a time series model context where things are varying through time. It works. Okay, you just go through the math, do a global edit. Wherever it says IW, inverse Wishart, make it hyperinverse Wishart. Okay. So the whole notion of modeling time evolution in a variance matrix is maintained when that's a highly structured variance matrix living on a graph, a particular graph. Okay, that's it. Details in the papers. Okay, so the examples. The little example first, this was discussed in our Biometrica paper with Carlos and Hélène Massam last year. So it's 11 dimensions, 2,000 data points. Not a very big data set, but again, we don't really care about the dimension because we're doing things sequentially. We're doing calculations sequentially, so you know, we could be using tick data, okay? There's no model here in the sense of no predictive ability. Okay, so these examples have no real econometric component, and this is the simplest model you can get in that framework. So the vector y, I've now taken the transpose out, is just a local level plus the volatility component. Okay, that local level is random walking through time. Okay, so we're just using the structural part of the DLM to adapt to changes in the data. So the point forecast f is just the current estimate of the level. All right? So there's no real econometrics in here. That's not the point. The point is to begin to get into the idea of, well, how much does a graph change things? Okay? Here's a fairly sensible looking graph, you know, one of millions for this particular problem substantively. It makes sense econometrically. All right? So let's run the analysis. Let's choose a particular portfolio rule and run the analysis on the graph and run the analysis that we've been running for years, for 20-some years, which is just the hyperinverse Wishart, unconstrained. All right? So there's 50-odd parameters in the variance matrix at each time here that in that standard analysis are moving slowly between time points. But there's no structure in the sense of reducing parameters. And this is the risk. So at each time point, 2,000 time points then, on each of those two graphs, you calculate your portfolio one step ahead, go ahead, etc. So you calculate the risk. You calculate the standard deviation of the optimal portfolio, S. So you can compare it between the two graphs. And this just looks at the ratio of the two, okay? And the line is at 1. So stuff to the right means risk is bigger than 1. Risk ratio is bigger than 1, okay, which says that the full graph, the traditional analysis, can be anything up to 5 to 10% poorer in terms of risk. It has higher risk. Okay, so that's one of the good things we were talking about. Right? The graph is helping in that sense. It's reducing risk of portfolios. Parameter dimension has been reduced by the graph. Okay? That's no surprise that that should happen. Okay, there were three other good things. One of them was, well, how much do we know about the optimal portfolio weights over time? The optimal portfolio weights, we can back up and think about them as being functions of the unknown precision matrix omega. So they have a posterior distribution at each time point derived from that for omega. So you can look at aspects of that, and this is a picture of, and this is interesting for other reasons too, this is the Belgian franc going through time over the period of days. This is just the variance of the optimal weight in the Belgian franc entry. And the red is the full graph, the traditional analysis, and the blue is the graph that we've been playing with, this interesting graph. So what we're seeing here is basically uniformly, there's more uncertainty about the weights in the unconstrained analysis, again, not surprisingly. So the graph pulls down that uncertainty. Okay? Haven't got a graph in this talk, got it in the paper, of weights themselves. Actually, the optimal values of the weights move around much more rapidly over time. I'll give you that graph in another example in a few minutes. Okay? So there's more churning, as finance people say, of portfolios. Money is being moved around under this portfolio strategy much more, time point to time point, related to this uncertainty about the weights. So the graph is helping on three of those good things. Okay? Sort of statistical things. The third one was making money. Making money is a good thing. So this is a comparison over time of net wealth under this the same portfolio rule applied to these two models that differ only in terms of the graphical model structuring. This delta down here is a number, a hyperparameter that defines this matrix beta distribution and is a measure of how much the model is allowing the variance matrix, the volatility matrix, to change over time. But we've got dozens of pictures of this form and uniformly across these kinds of examples. So you start off in a case of uncertainty where things are very, very similar between the two models. And this is just going through time showing how the blue curve is changing. That's how your net wealth at any given time, that is your net wealth at any given time, as a cumulative percent of your initial wealth if you follow that optimal portfolio strategy. Okay? And there's there are periods where they come together initially, and then there are periods where they're quite a long way apart. So on the fourth good thing, or the first good thing, the graph is helping. Okay? So the graph is a good thing on all four metrics. Okay? Sparsity, structure, it's not sparse, but structure is beginning to help. Okay? So now we're going to go to slightly higher dimensions. We're going to go back to the S&P and run the same calculations. Okay, exactly the same comparison. Okay, so here we've got 350 stocks over a period of days, and this is basically 366 interesting stocks. And I'm going to start talking now about where does the graph come from. Okay, because this is where we don't know how to do things much at all, actually. There are lots of graphs. We're just looking at one graph on 11 nodes. There are lots of graphs on 11 nodes. On 346 nodes, what are we going to do here? We're going to have to look around and try and ask questions about, can the data help us find graphs? Okay, so we're going to start in on the question of, well, we've got a big matrix, 350 by 350. We've got to reduce dimension. We've got to find low dimensional structure. There's going to be massive graphical modeling structure. But there's going to be huge numbers of graphs that are basically the same for all practical purposes. So one of the things we've done is build on some prior work by Beatrix Jones and others on thinking about Markov chain Monte Carlo in the hyperinverse Wishart Gaussian graphical model framework, in exploring model space, exploring graph space. And using shotgun stochastic search methods to do that. So the basic idea here is critically dependent on an ability to calculate the marginal likelihood of the data on a given graph, which I'd mentioned earlier. Okay? In the time series context, then we're doing these calculations at each time. So this product of ratio forms for the marginal likelihood evaluation is done repeatedly at each time point. And then by composition, as we go through time and we see more data, we build up the joint density of all of the data, integrating out all of the parameters, including the volatility matrix. And that gives us an evaluation for the fixed data set of the likelihood function on that graph. And then we can look at another graph and do the same thing, and another graph and do the same thing. Okay, so you give me a list of graphs, I'll do those calculations. And the methodologies, of course, Markov chain methodologies implicitly, and our search methods that are basically the same but tweaked in an interesting way, are local calculations. Local now in graph model space. Okay, so here we are at a graph. You gave me a graph. I might look around and say, well, let me look at all of the graphs that have one more edge than this graph or one less edge. Okay, some kind of neighborhood of this graph. Well, if I do that in the decomposable graphical model framework, calculations can reduce quite considerably because we're looking at an edge that might live in a separator or a couple of the components of the graph. And the product ratio form of the marginal likelihood means we only have to zoom in on the components in that product ratio that involve that edge. Okay? So all of the rest is maintained. And if we're dealing with 350 dimensions, we've got lots of components. So a lot of the calculations get reused. Okay, so generally, and this was a development of stochastic search in regression. This was in the graphical models. A model is a graph. Here we are at a current model. Look at all of the one-edge neighbors, say. Evaluate their marginal likelihoods, evaluate their conditional, their unnormalized posterior probability. We've got to talk a little bit about probabilities on graphs, prior probabilities. And then move to one of them, or two of them, or several of them. Okay? Select one at random based on those conditional probabilities.
Are you only searching among decomposable graphs?
We're only searching amongst decomposable graphs today. All of this and all of the examples is decomposable. Okay. We can do it all. We can do it all. All of the theory goes through the marriage of dynamic models with graphical models is generic. That applies to non-decomposable cases too. What we can't do, what nobody knows how to do well, is evaluate the marginal likelihoods at all well on non-decomposable graphs.
So you want us to
Each of the components is a completely connected graph, as in my example. Let's talk a little bit about MCMC. So people have been doing MCMC on Gaussian graphical models in low dimensions, and it can work very well. So MCMC has this setup. And the best way to do it, I think, one of the best ways is to say, well, let me look at the current graph, flip a coin, and if it's heads, I'll add an edge. If it's tails, I'll delete an edge. And then choose an edge at random to do that operation on. Okay? In a Metropolis Hastings framework, that's a proposal for a new graph. Okay? And move around the graph space like that. Okay? But when you're in more than a few dimensions, and the number of assets is low, this is fine. But when you're in more than a few dimensions, of course, the Markov chains that are built like that are just hopeless from the point of view of convergence. You're not going to explore posterior distributions over graphs. But there's some good things about that search that we've utilized in stochastic search, which is to forget about Markov chains and just use the basic idea of local moves and look around a current graph at all of its one-edge neighbors and evaluate them all because we can do the calculations easily on decomposable graphs. And then move to one or a number of those based on those probabilities in whatever way you decide. Okay? And so what this means is that as you move around like this, at each point, you're evaluating a whole set of models, a whole set of graphs. So you're building up a catalog of where you've been and mapping out parts of this very large model space. Okay. You can run this in parallel very easily. And you're moving to regions of high probability over graphs rather than high density, high probabilities on individual graphs. If this is a good graph, it has high probability, then many of its neighbors are going to be good graphs. And you catalog that. But again, critically, as was just behind the question asked, you have to be able to efficiently compute the marginal likelihood, which is why we like these particular models. Okay. So that's how we're doing some of the calculations to build up information about what are interesting graphs. Okay, squillions and squillions of graphs can be identified this way, listed, ranked, and depending on how their relative posterior probabilities fall out, you're only exploring a chunk of the graph space. This finds good graphs. All right? This gets us into questions of what do we want to do with them? Do we want to average over graphs as a nuisance parameter to predict and make decisions? Do we want to select one to use or a number to use? And I'll get back to that in a few minutes. So back to the S&P. So we applied this kind of idea to the first 1,200 days, ran the model, a model, on the first 1,200 days, and did this search over many, many, many graphs. Okay? And then just used some of those graphs to predict and portfolio for the remaining days. Okay, so select 1 million graphs and run them in parallel over the next 300 days. And the point is simply, again, comparisons. So here is one of the local modes in graph space that we identified. It was the highest probability mode we found, graph we found. This is the same cumulative return comparison. Down here, the blue curve is independent assets. The stocks and the S&P are independent, the empty graph. And the green curve is the cumulative return. I'm sorry, the blue curve is the S&P. The green curve is the empty graph. The red curve is the full graph, the standard model. Okay? So a good graph in terms of posterior probability found our way, not the best local mode. There may be many higher probability graphs out there. Is dominant in terms of returns. The structure in that graph is clearly saying something that the data likes. Posterior probability is high. It's not guaranteed that a posterior probability graph is going to be the best graph for predictions and portfolio or classes of high probability graphs. But Bayes' theorem tells us we should be looking at high probability graphs and averaging them for prediction. The posterior distribution is hugely flat regionally in graph space, of course. But across many, many graphs in this high-dimensional problem discovered this way, lots of good graphs in the sense of high probability have good return risk characteristics. Okay? So in a relatively high-dimensional problem, and this is not just this is a big, big problem. The structuring defined by regions of graph space that the data like seems to be relevant, seems to be good from the point of view of the decision problem. Now, I'm going to give you another example that goes the other way. I should skip this, I think, because I want to, well, let me say a few words about this. Since I didn't show you a graph like this, this is the optimal weights on a few of the companies on that local posterior mode graph in blue and the full graph in red. So the full graph's going to move around. It's going to churn more. You know. And it whips around quite violently. This is, for those of you that are sitting at the back, Apple. This is Boeing. And this is Coca-Cola. So you'd be going fairly substantially short here on Coca-Cola stock, quite dramatically at this time point, and really selling it off and getting into futures and so forth. The sum point is the structuring on this particular quite sparse graph, not very sparse graph, is sort of mimics what all of the financial advisors continually to tell people to do. When the market goes bad, don't sell. And don't go and find a new financial advisor. Okay, stay in there for the long haul. Okay, so there's more stability and less churn, and we know we've just seen it makes money. Okay, model averaging or model selection. So there are different views on this. So Bayes' theorem tells us to model average for prediction. Integrate out uncertainty over all of the things you're uncertain about. Okay, and sort of implicitly, if you're going to make decisions based on the statistical model, then average over everything in sight as well in making those decisions. Okay. Well, you can't do it in this kind of problem because you don't have a posterior distribution over the models. You have a conditional posterior distribution conditional on the models that you've discovered or that you decided to evaluate. Okay. And there are many, 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 many models that are just indistinguishable in terms of how they behave in the decision problem, with quite violently differing degrees of sparsity. Do you want to pick a graph? Do you want to pick a few graphs? Do you want to average over them? Well, let's look a little bit more at this on another example. We started 5 minutes early, Mr. Chairman, yeah? Sorry, 5 minutes late, yeah? Well, I'm going to have to cut short this example, but it's a recent example. This is the example the undergraduate Craig Reeson, who's a co-author on a tech report, has been working on. I personally have some money in Vanguard funds. But it's interesting econometrically too, because there are only 30 funds here. From a number of points of view, but from one point of view here, that 18 of these funds are managed funds, and 18 are index funds. So the index funds are just indices. One of them is the S&P, the Standard & Poor Index. Okay? The others are just averages, known averages of sectors in the market. Okay? So there are a number of stocks that will be defined as growth stocks, and the average of those, the returns, is the growth index fund. And you can buy these basically for free, once you've bought into a particular company. The other 18 funds are managed funds. So these are managed typically by a group of managers who are typically highly paid and highly rewarded if they succeed. And they cost a lot more to buy. And companies like Vanguard spend a lot of time trying to pretend that when they sell people the opportunity to buy into these funds, that it costs the same as index funds. Otherwise, people wouldn't buy them, okay? Because they're expensive, very expensive. Does it matter? Do managed funds make more money than index funds, or than portfolios of index funds? Okay, you have the opportunity to buy into a portfolio of all of the managed funds, all of the index funds. So we're going to look at this a little bit in exactly the same framework and quickly run through this since time is pressing. Get back to this question that Bernard asked earlier. So just to help think about this, if you run an analysis and forget about what the model might be of the form I've been describing through time and just use a minimum variance portfolio, you'll get a picture like this. It starts off where things are sort of balanced at the start because we've got big vague priors on everything. And as you learn about the structure of the model going through time, as you learn about the volatility matrix and the patterns of covariance across funds, this is on the full graph on 30 funds, things begin to separate out. So, there's a zero line here. Minimum variance, you're not constrained. You go short on these funds represented down here. These are obviously the highly variable funds. And you go long on the more predictable funds that tend to have some positive return. Okay, so bear that picture in mind. We go to this picture. If you now start thinking about yourself as an investor, if you are constrained to put positive amounts of money into these funds, or non-negative amounts of money, and you're not a hedge fund, then some of those weights get pushed to zero pretty fast, and basically this comes down to money over time in 3 or 4 funds. Okay, and if you add the idea that you want to be sort of speculative and that you want to push this with a target portfolio where you want to guarantee that your portfolio has a given expected return. Same general story qualitatively that comes out there. And this is nice because it tells you don't have to worry about 30 funds. So when you rebalance your retirement funds, you don't have to think about more. You only need 3 or 4. Okay? The trouble is you don't know which 3 or 4. Okay? Okay, model uncertainty, model selection, model averaging. The best graph we got so far in terms of a local mode in the posterior distribution, I didn't mention it, and we can talk about that afterwards. The edges are in or out independently here with some probability. Prior says you expect each fund to have 1 or 2 neighbors. And I've displayed this so that the red funds are the managed funds, 18 of them, and the blue funds are the index funds. And the names are on there, and it all sort of fits together in terms of what these funds are supposed to be doing. But this is just a picture where black is something that's non-zero and white is 0, just to give you the flavor of the sparsity, if you like, of the 30 by 30 covariance matrix sitting on this particular graph. So this was the high posterior probability graph. And what you see, one of the things you see is a chunk of the index funds that are highly positively correlated down here. Well, they're index funds. They're all built on the same stuff. What's interesting up here then, from the point of view of this issue of managed versus index, is which of the index funds are relevant in terms of being associated with a managed fund. Okay? And we'll look at this again in a second. So that's the top graph. And of the many millions or billions of graphs that we generated, curiously enough, as we look at posterior probabilities on the graphs we found, conditional posterior probabilities, conditional on the models we found, you probably can't see this very well at the back, but I've shaded this with that conditional posterior probability. So white, yellow is fairly low, and then it comes up to red and black. And this local mode has most of the structure in this posterior probability on edge inclusion image display. Okay, so the structure in that graph is at least in the search that we generated here, sustained across graphs that have reasonably high probability. Okay, so a couple of pictures. So there are different ways to look at this question of what does parameter constraint sparsity mean compared to posterior probability over graphs when it comes to thinking about how the decision problem is impacted. Okay? So here's just a bit of an in on that. What we have on here is log probability, okay? And what we have on here is sparsity, the percent of edges that are in the graph. And each of the dots is a graph. And I just selected, I think, a few thousand out of the squillions that we generated, so the printer didn't die. And so we would still be waiting for the graph to come up on the screen if I put them all on. So what we have here is the full graph, of course, sitting out there. It has all of the edges, and it has low probability, okay, compared with a lot of high probability graphs. What I've got here is some measure of average risk, okay, so this is just looking at each of the models over the period, and the number is irrelevant. It's the ordering that's important and the structure of the picture. So these are lower risk and these are higher risk, okay? So the higher risk graphs have lower probability way down here, but these are the interesting graphs from the point of view of risk as we get along here to the low end of the scale. They tend to have higher probability. Well, that's nice, okay? Now the color coding, of course, is the return, is the realized return over the period of time here. So red is good. So what we see here are, as we get lower and lower risk graphs with higher and higher probability, we tend to get into higher return graphs. But then there's a lot of green and blue coming in up here. Okay? It's easier seen in well, any one of these pictures. Let's look at this one here. Okay? These are just the two-dimensional scatter plots of that 3D plot. Same color coding. So here, as we move up in probability, we've got low return graphs, we get higher return graphs, high return graphs. There's some red ones hidden in here. But you see a predominance here of slightly lower return as you get high probability. Okay? When you look at that in terms of sparsity, you see that the very sparse graphs are really winning in terms of return, even though they don't win in terms of posterior probability. Okay? So the decision endpoint use of these models, these class of models, to a degree, the posterior probability, you get the same graph if you use the likelihood and not the posterior probability. Same graph, same picture, same conclusion. The graphs, you know, it's not a given that we should be just model averaging, because a lot of the top graphs are really not the money-making graphs at all, okay? And they're not sparse enough to approach the top graphs if you measure just by return. Okay. So my bright undergraduate student said, well, hey, you know, I might want a job in a hedge fund one day, so what do I care about probability? I'll just take all of the billions of graphs we've found and look at each one of them and run the stochastic search in neighborhoods around each one of them, or something, run a greedy hill climbing around each one of them, based not on probability, but based on return, based on some risk-return balance, a Sharpe ratio. Okay? And just use the statistical machinery to find interesting graphs from the point of view of the decision problem. Okay? And the graphs discovered there, and the same with frequency-weighted edge occurrence probabilities, are quite a bit sparser. Okay, there's more constraints, there's more reduction in parameter dimension, more stability in a sense in most of them, and econometrically say very different things. So for example, they're pushing away from graphs which say that the index funds are correlated. Okay? They're pushing into, statistically and econometrically, very different regions of graph space. I'm going to have to complete because my chairman's, I've got several more slides, but my chairman's waving at me, so it's nearly done, not done. But, so I'll complete here. So there's a marriage of models, time series models and graphical models. As an aside, we're also very interested in factor models of covariance matrices, as many of you know, and sparse factor models of covariance matrices in finance and other areas, and sort of see them as different at the moment because they're models of zeros in variance matrices instead of precision matrices. But some of the models that we play with have factor model components in them as part of the volatility structure too, along with the graphical model. But the main points statistically are really questions of computation, number one, and then these questions of when you're in spaces you will never explore, and you follow the rules statistically, and they conflict with the interest in lining up lots of different models as part of a decision context, which drives in a different direction. What is the relevance of the statistical class of models defined statistically in that context? Some of the interesting questions we're looking at now is priors over graphs that help us focus on substantively meaning graphs, econometrically meaning graphs, and my little 11-node graph at the start was part of that. That's for a different talk. But one thing that is very, very important in this particular area is the business of graphical model uncertainty, and this whole idea of learning about what structure should we be thinking about as we move through time, rather than in this batch context. Okay, so if we now move into a sequential context, carrying along many, many graphs as we go through time, how do we do that? How do we think about moving into that domain? Largely computational, but certainly open for research. Okay, I'll mention this point because I think it might interest somebody theoretically. Okay, I'm not going to tell you the story because I'm done. If we take the 12 index funds and one managed fund, we've got 13 dimensions, and we integrate over the other dimensions and reduce from 30 to 13. Okay, we start with a graph on 30 dimensions. It gets busier as we go down to 13 dimensions. Okay, so if we want to start in 13 dimensions, thinking about certain sparsity patterns, numbers of edges, prior probabilities of edge inclusion, and then build a model on a higher dimensional set of nodes, the way we think about that model and the way we specify that model needs to be informed by how things change as we move between dimensions. Okay, and we've done a little bit of theoretical playing around with this and have a first start on some of this. But it's sort of random graphs and random matrices stuff, and I know there are people here that might know a lot more than we do about that. Okay, so I'm going to skip ahead because I'm not allowed to say anything about that. There's a website. Well, you can go to my website. I thought I'd put in this paper here for those of you that might not know anything about or much about dynamic modeling, in particular in financial econometric contexts, which is a very nice sort of review article published in the Valencia proceedings a few years ago. And the papers and an upcoming tech report are available on my website. This is the main paper by Carlos and I last year. Thank you for your attention, and I'm done.
Well, I think we can spare 5 minutes for questions, and then people drink their coffee. Questions?
So, a lot of years ago, there was a trading strategy of pair trading. You just look for two stocks which were highly correlated, and how different is
Highly negatively correlated.
highly positively correlated. And you would look how much they deviate from. How is different? How is this? I mean, do the weights that you find, are they similar in spirit to exactly this type of strategy?
I don't know. I don't know the strategy you're talking about. I mean, the whole point of all investment, quantitative or semi-quantitative methods, is to exploit correlation, whether it's positive or negative. I just don't know the specific strategy that you're referring to.
They would find two stocks which are highly correlated, and when one and so they have a linear regression line. When one of the stocks is above that line, you.
I think as one of the early slides said, if you have high correlation, you can predict X from Y very well and Y from X very well, and it comes down to the balance of what is the conditional variance. The portfolio decision rule would choose the one that is least variable. Okay, all other things being equal.
Okay.
So you said that your student found that the best performer was that covariance or inverse covariance that was much sparser. But sort of a naive view of it was that it's just much more diagonal, and that maybe the covariance structure is kind of not even there. There's no covariance, and or let's say whatever covariance you think you've observed doesn't help you.
So that's a picture over here.
Well, you had another picture that was much more filled in. That was supposedly the most likely covariance.
So the first set of pictures, there's more density over large numbers of graphs with high likelihood, high probability. They're both the same. When we start looking at, and this was just the top return graph, okay? And this is I can't remember how many, a large number of ranked by return, just taking the frequency of edge occurrence, and they are closer to diagonal, with the exception of a couple of slightly interpretable stocks, in particular the U.S. growth stock. What we don't have here, though, is risk. Okay, this picture doesn't show risk. Okay, we should be looking at a graph like this for some composite Sharpe ratio, something like that, to really understand that. But it certainly is closer to diagonal, and the flavor is of that nature. Now, when we go with a diagonal graph, of course, it bombs. It bombs. I think so. The overall question, actually, question here is, what is the goal? Most of the modeling work that certainly we've been doing and other people have been doing was just focus on trying to better understand uncertainty about models and parameters within models. The end game being short-term forecasting and decision making, and now the realization that there are just very different regions of graph space with good properties in terms of the decision, then seem to be matching the data. And maybe there's something new here in terms of investment management thinking. Maybe there's not. It's certainly intriguing.
Okay, I think since it's 10 after, perhaps those of you who have further questions for Mike can postpone it to the coffee hour, and let's thank Mike.